Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I will be your host for the next 25 minutes here on Options Guide TV. Well, markets are befuddling once again. We're kind of just hanging flat. Obviously, unless you've been living under a rock, you realize that there's a lot going on geopolitically over in the Middle East. The Straits of Hormuz are going to be blockaded by the U.S. this time around, and the markets are just got a whole hum feeling to them right now. We're looking at the S&P 500 index just up barely at this point in time. I'm going to actually call it flat. The SPX is up $4.40. And we see the VIX come down below 20. I'm not quite sure. I've said that was great for our VIX trade that we had on. That's actually going to expire on Wednesday. But that the VIX is trading around 20. We got the VVIX down below 110. It's trading at 107. Now, remember, that's the VIX of the VIX. And anywhere above 120, it usually is, let's say, like, higher than normal implied. Below 100, I would call a little bit more normal. And we're right at 107 on the VVIX. So the VIX at 1986, S&P flat. We across the board, almost all the indexes are flat, and we're running into earnings season. Goldman Sachs kicked off earnings this morning, and they actually had a solid report. The thing that drove Goldman down a little bit, because it is leaning a little bearish at this point in time, is their trading volumes in the bond area, in the fixed income area. The trading volumes were way down. Now, overall, it was a fairly solid report, but Goldman has had some upside recently, strong over the year, but obviously volatility, just like every other stock over the last month or so. I do think it's a little bit of an opportunity to sell it off. I actually, if you're looking at Goldman and thinking about buying some more long, I see this as a buying opportunity. I think Goldman is a good buy and hold in that space. Now, we have JP Morgan, who normally kicks off earnings. They're going to be announcing tomorrow. We also have BlackRock. We got Citigroup announcing. Johnson & Johnson is announcing, and they've just been really strong recently. And then on Wednesday, we have Morgan Stanley. Morgan Stanley actually had an interesting report that came out about the consumer, kind of talking about credit card spending. Consumer sentiment is very low, and that usually happens when gas prices are high. But the spending that they're seeing in their credit card division is implying something different, if you will. But obviously the lower income is struggling whenever there's gas prices, but the middle tier still seem to be doing okay, and the consumer still seems to be spending, which is just been kind of the story of this marketplace as a whole. As long as the consumer stays strong, we see the markets very resilient, and at this point in time, we're just kind of hanging out, and it's that simple. As a matter of fact, you look at a few of the things, like I always look at the Russell long straddles, VIX coming off. I could see doing a long straddle in the Russell 2000 index, but we got too much going on with earnings. Just to say that if you're going to go out a few months in time, if you do actually think that this, if you do think that in the next couple, the conflict over in the Middle East is eventually going to go away, that isn't a bad trade. Concerning, I think the VIX at 19 is extremely low relative to the risks of the marketplace. And it came down precipitously. It came down the first time around when we announced the ceasefire that was happening. And then the ceasefire just basically, that didn't happen. And ideally now, we're still escalating. But bottom line is the VIX is showing strength. Less uncertainty in the marketplace. Okay, so I want to look at Morgan Stanley, and then I also like to look at getting short a stock. And I've been short. I don't remember the last time if we were doing it on Options Guide TV, but I've been short the airlines ever since the conflict has started. And United Airlines is going to be announcing they're trying. Delta came out and said that they're seeing strength in bookings and showing some positivity, but I think a lot of that's gonna end up showing up in their next earnings report that's coming out. And United is going to be announcing on the 21st UAL, and I want to get short UAL. So to start, let's look at Morgan Stanley. And we're going, and it's a nice setup for the open wing butterfly. And I don't mind if you just do a standard long call spread, but that's not my MO. So I'm going to look at the open wing butterfly in Morgan Stanley on a short term basis, expiring on Friday. If I was going to look at a long call spread, I'd probably go out to the 24th, which is 11 days away. So we're seeing the change right now in Morgan Stanley. Here's the trade that I have set up. They're announcing on Wednesday before the open. So we're going to have a show on Wednesday right after the announcement. So we'll be able to see how our trade is working out. And the market right now at 177.86. We're going to look to use the April 17th expiration this Friday. And we're going to buy the 180 strike call and then go 5 points up and sell 2 of the 185 strike calls, and then buy 1 of the $187.50 strike calls. So our long call spread is 5 points wide, and our short call spread is 2.5 points wide. And that makes up our 1 by 2 by 1 butterfly. We can get this done for $1.17 right now. That means that we could do it for $117 per butterfly that is put on. That will be your max risk on the trade. Now, our max upside will be $5 minus that 175. But if we do continue on up and say we gap open after the earnings above 187.50, we're still profitable on that trade. So I want to show you this inside the what if calculator. And let's pull this down a little bit and highlight it. So in this instance, here's where the underlying stock is at, 177.90. Right here, now I think it grabbed about 117. So these are going to be rounded off a little bit. But right, if we hit the precipice of our peak in our butterfly, we're looking at potential to make $380, which is the net debit paid minus $5. If we go above 187.50, the highest strike in our butterfly, we're still profitable. And at that instance, we can make $133. So we can double from that point on up. And I like that. I like that number where if you get that more than one standard deviation move, you can double your position on the trade. Now, our best case scenario is that it makes about half of the one standard deviation move and it lands right at the 185 strike. And then, of course, if the market goes down, the maximum we can lose on the trade is the net debit that we paid. And at this point, that's $1.17 or $117 per open wing butterfly that we execute. I do think from the signs of the report from Morgan Stanley recently and the fact that they're kind of talking about the strength of the consumer, I do think that could be a little hint. So the stock recently, and a lot of the financial stocks, in particular banks just in general, have had a strong move recently. And part of that is because of a regulation tailwind. They're basically implying that the net capital requirements could be reduced quite a bit. And we saw Morgan Stanley make a jump. And if you look at the chart on on Citigroup, you also see that made a strong move after that news report. And so let me pull in. I got United up. Let's do Morgan Stanley and take a quick peek at that. And I'll zoom in over here, and you see this jump here. And then you also, if we pull up Citigroup, who's announcing tomorrow, and boom, you see Citigroup. They almost look the same, right? Citigroup is interesting, but we're hitting a resistance point. I didn't want to trade that. I didn't want to get bearish. Didn't want to get bullish because we're right at a precipice here, right? This is a new high. We're trading right at that new high. As a matter of fact, if I zoom in right here, I don't think it made a new high. I think we bounced off of that. So it would be if you got a strong earnings report or strong perceived earnings report. Breaking out to the upside would be really good for Citigroup. But actually, kind of proud of Citigroup. It's done really well. Used to always be a laggard in the space, but recently that stock has been really strong since I guess it's beginning beginning of the year. I'd say right down here at the bottom. This was in April. Go 2025, going all the way back. So strong move, obvious volatility back up to this, and we're right at a level where you could see a potential sell-off, even on good news in Citigroup, just because of that huge run-up after that news about the regulatory potential capital requirement reduction. All right. So Morgan Stanley's got a little bit more headwind, or a little bit more room to run relative to its most recent high. So I kind of like Morgan Stanley. Not to mention the fact that we got all of our ducks in a row in Morgan Stanley. Here's the 200-day, here's the 20-day, here's the 50-day. The 20-day strong going towards the 50. You would ideally, the sign of a real good strong stock is if you have the 20-day ahead of the 50-day, and then you got the 200-day below it. But I like Morgan Stanley, and then Goldman today. I'm wondering if it's still selling off right now, down 3%. But they also will benefit from this. Wow, that looks a lot like the chart in Morgan Stanley, right? Goldman Sachs, yeah. That looks a lot like the chart in Morgan Stanley, even with the it's almost mirrors each other. But I do think that this sell-off in Goldman, especially considering the news about the CapEx requirements. With that said, I think Goldman is out of the group. I think it's the strongest buy. I'm going to get long Morgan Stanley going into that earnings report. And if you think the conflict in the Middle East is going to wane a little bit, that should help things. Well, it should help things across the board. We already saw the type of move that we had after the first announcement of a potential ceasefire. If we could actually get a resolution, I think the markets would be really strong. All right. UAL. This trade, I like this trade in general. I think it's just a fun trade. Well, let's run over to UAL. So we're going to look at United Airlines. And I do think that the airlines are going to continue to struggle. I think that everything that happened with the government shutdown, on top of oil prices still being sticky. Today, we're back up over $100 on a barrel of oil. It's going to start showing up. United Airlines is known for not hedging oil prices. It is one of the majors, and there are some potential for some mergers in the airline space, and a lot of people have said that maybe that needs to happen. But that is one of the things about this, about the struggles that they are having. But I don't mind getting short United Airlines heading into their earnings report, and their earnings report is on the 21st, so it's this expiration. And I set up let's go to the what if calculator, a long diagonal. And I like this because the stock has been down, so the front month has some vol in it. So it's a little short on the diagonal. I mean, ideally, we probably would have set it up next week. But I didn't look at it until today, to be blunt. And now that I looked at it this morning, I decided, I want to talk about this today on the show. So here is what we're doing. We're doing a long diagonal in UAL heading into their earnings report. And let's send it to the what if. Let's send it to the ticket here. And let's see where it's at right now. And we'll go back to the trading tab, and here it is. So we got 2 months that we're working on. Now, this isn't, if you haven't done a multi-expiration trade, this is a fairly advanced trade, and we're going to do it around earnings. So it's a little bit counterintuitive in that if I ever do diagonals, I like earnings because we know that as earnings approach, the expiration that has earnings usually has a tendency to creep up. And the expiration that doesn't have earnings that we're looking at here usually starts to wane, or just stock kind of settles in and waits for that earnings. So in this instance, we're still selling 61 vol. There's still a lot of vol premium, and it probably has a lot to do with just the conflict in the Middle East and everything that's happening in general, and the stocks getting beaten up a little bit. Vol has a tendency to go up because of that. So we're going to buy. So here's the trade. And United Airlines, we're looking to buy the April 24th expiration. We're going to go a little bit in the money. We're going to buy the 97 strike put. And I'm going to focus on the time premium, which right now is $3.14. That's the extrinsic value or time value. And then we're going to go in the short term, the expiration that expires before the earnings announcement, and we're going to sell the 90 strike. And that 90 strike, we're still getting $1 for it. Right now, the bid is 96 cents and the ask is $1.02. So I'm going to call that $1. And that means that we're putting on this entire trade here for about $5.11. So my goal here is to be long a put at a much cheaper valuation. Now, if the stock goes down to 90, prior to the expiration date, which is 4 days away, April 17th, if the stock does do that, we need to adjust this trade or get out of the trade. We're still going to be profitable on it. That's a good thing. We just don't want that 90 strike put to get in the money. So we would just close it out going into earnings, anticipation that the longer put option is going to go up in implied volatility, and the shorter put option, we're just hoping for that to expire so that we can collect that $1 premium and make it more cost efficient to buy our long put. Now, if we want to, if the market does go against us, let's say the market starts bouncing up, which would be a bad thing in this instance, heading into earnings, and that short put still expires, which it would expire worthless if the underlying stock actually went up. And we could sell another put and bring in some more premium. So we could sell the expiration of that earnings report. And then we could bring in some more premium from that and still hedge our risk. So like I said, even though the fact that implied vols are so high on the very short term expiration on the April 17th makes this diagonal spread really interesting if you want to get bearish on United Airlines as they head into their earnings announcement. Now, our total net risk to start with is $5.11, but you have a little bit more risk because we are doing a time spread, and you can't just put this trade on and fall asleep. You're going to have an option contract that expires prior to your long option contract. And if you get put the stock, you'll be expected to pay for that stock. You are covered. You have the right to exercise and sell the stock at a higher strike price, but it's a different expiration. So it adds in a level of complexity. But in theory, if you just look at it and you don't worry about exercise and assignment, the net debit paid for this diagonal spread is your max risk on the trade. Just don't fall asleep at that first expiration on April 17th. So I like both of these trades. Morgan Stanley, I like financials with the recent news about what's going on with regulatory requirements as far as capital is concerned. And then I think the airlines are going to struggle. We saw a little bit of a pop after the ceasefire. I think of that some of these costs for fuel are going to show up in their earnings report, and they might try to sell it a little bit as, well, maybe we've got some strong growth, but it's hard to bounce back from everything that has happened to the airlines in just one quarter here. So I do think that getting short UAL, and because of the volatility metrics that are going on, a diagonal spread in UAL is very interesting. That's it for this edition of Options Guide TV. We'll be back on Wednesday. We'll look at the Morgan Stanley trade because they'll be announcing in the AM. United Airlines is a little bit away, so we'll have to come back and take a peek on that. But on Wednesday, we'll look at a few more. It's the beginning of earnings season. It is the season. So we'll have a lot of interesting trades to talk about over the next couple of weeks. Thanks for stopping in. My name is Brian Overby, and I am the author of the Options Playbook. If you'd like to see more of this, please go to hub.tradier.com. Please make a profile. Show traders some love for putting together this entire gaggle of analysts to kind of help you out in your option trading and in your normal everyday trading. So thank you for stopping in, and we'll see you Wednesday, 11 a.m. Eastern Time for the next edition of Options Guy TV.